Um, as you are aware, our focus is to really see how capital is creating consequence for the next decade. And given that background, I would like to begin with asking this question. While the Indus Valley seemed to have really become a valley where there is a lot of traffic, there's a lot of capital, a lot of action, um, and it seemed to really be buzzing, but at the same time, I'm sure that their wealth of experience would give us a sense of what has really changed in terms of what they back, what they are willing to back, and how has themes emerging from just having to put money versus, we are very conscious of the kind of consequence and value that creates for the Indian economic uh, environment and society. So with that, let's ask each one of the panelists spend their early thoughts on what is it that they are willing to back up now compared to what they were willing to back earlier. Is there a clear evolution that we are observing? Let's start with Aastha.
Interestingly, I think because the industry itself, I think the venture capital, private equity asset class in India has also matured over the last 20 years. A lot of things are following the same trend, which means that controls are tightening, focus on performance versus potential is tightening. When we actually diligence an industry or a company, we're a lot more focused, a lot more conscious about how the past has performed, not just in India, otherwise. So I think the earlier waves may have been a lot more about potential and how big India as a market could be. I think it's becoming a lot more performance focused. And of course, we're not where the Chinese and American markets are today, but I think this is a wave we're sort of following through there. Yeah.
Yeah, I think your mention is about necessarily consequences is actually becoming very evident because you are more concerned about potential or increasingly so recognizing it. So let's hear from Anirudh on this. Yeah.
Yeah, I've been in I've been investing in India since 2009, and I remember when I started in my career, Flipkart and Ola Cabs and all these companies were just about starting. They were all at seed stage, and everybody was passing on those deals because they were so contrarian for the time. But at that time, the bet was mostly on consumer facing business models, mostly in tier one geographies like Delhi, Bombay, Bangalore, etc. I think from that point to now, over the last 15, 16 years, the change I have seen is that the ecosystem has grown massively. There are a lot of ecosystem enablers now. You've got angel investors, you've got people, founders who made money, who are supporting new, younger founders. You've got second-time founders. You've got seed stage funds. You've got incubators like IMA Ventures. You've got a lot of support. Entrepreneurship itself has become a very, very legitimate, career option now. So as a result, you see founders willing to take more risks and trying to tackle harder and harder business problems. So now, instead of consumer, obviously consumer always remains a great space to invest in. We also see a lot of old school traditional industries being disrupted by technology, which 10 years back, no one would have thought of. And technology investors wouldn't have thought of investing in them because of issues like capex heavy, working capital, things like that. But I think the big change for me is that today we are seeing a lot of these traditional industries being disrupted by technology, and in many of these sectors, India is actually leading globally because you don't have equivalent business models and technologies and companies in even the US, Europe, etc. So that to me is the big transition.
So, Bearing has been in the business since 1998. It was started in India by Rahul, who's sitting here. And I can talk about 30-year, 20-year, 10-year, how things have evolved. But I think if I have to put a single theme to it, it has evolved the way India has evolved. Our business has three components driving it. One is the raw material, which is the supply of deals. Supply of deals usually comes from things that are growing fast. Things that are growing fast come from what the consumer preferences are, what is being supplied by the ecosystem. The other side is the capital side of it. So the capital markets are also evolving. The risk-taking ability, the number of players, like Anirudh mentioned just now. the depth of the capital markets. And third is the people who give us the money, our own investors. So all those three things have evolved over the last 30 years. Initially, it was all the foreign overseas investors who were just testing out India. India में पैसा डाल के देखते हैं क्या होता है. So they were much more easy with, you can do multiple things as long as you make them money. They were happy. Later they evolved. They said, no, we want buyouts. We want only a certain category of control transactions, which should be PE. Our own team belief was very different. Our own team belief was that if you're doing this, it has to be in a situation where we are adding value. It has to be in a situation where we think it will make money for our investors, whoever the investor that is. And that came from where the opportunities were. So there is a competitive dynamic to it as well. If everyone else, like Anirudh mentioned, people in 8 or 9 were putting money into consumer, then there was a huge boom of these consumer startups, ride hailing, quick commerce, this, that. We, over the last 10 years, figured out, yeah, this manufacturing, deep tech, your hard technologies, nobody's putting money in. So it made commercial sense. It was not just from, it was also good for the country. But it was not just from that angle that we thought that it was actually going to make a lot of money. I'll just give you an example. For example, Loham, when we saw it in 2020, it was making 1 crore a month of revenue or thereabouts. We got it for less than 100 crores. Today, I mean, that kind of company, if it was in some software or some e-commerce, it would have got 100 million valuation. So it was just made much more commercial sense to do that, right? And it has actually played out. Now it does almost 100 crores a month of revenue. Similar company, Satshore, it was giving technology to banks to, make better credit decisions using AI. Now, I heard a lot of other panels previously say AI India mein nahi banega, bahut mehenga hota hai. But we are seeing in Satshore, also another company in Tangles, which we have done with Avataar, they're making their own proprietary models. You don't need to make a LLM to do AI. You can do it for specific areas, right? So there's a lot of opportunity here. Just to summarize, we use whatever we were taught in this institute, the way we studied. Look at the fundamentals, look where the demand supply is favorable, look where the market is moving, look where competition is less, look where you get more value, and then decide your investing strategy.
Thank you, Arul and Anirudh. I think what we hear is that, okay, there was focus on consumer, then there is focus on industry segment, how AI is disrupting it. And, one can clearly see that money is going where India is evolving into. And let's hear from Sudipto on, does he really see any mega trends which is working out in terms of the shifts that he see from where he has begun versus where it is?
Sure, sir. So I started investing 10 years back. I'm class of 2016, so it's sort of being back in campus after 10 years. Broadly agree with what everyone mentioned. I'll just emphasize on 2 points. First is in 2016, when at least when I started investing, right? We used to look a lot at East and West and see what models have worked there. And we would essentially fund the Uber for India, we would fund the Stripe for India, and that's why we invest in companies like Ola, Razorpay, etc. What has changed is the needs for India over a period of time has actually been very different than what both US and China are. And a lot of the new investments in the last 5, 6, 7 years is focused on Indian needs. Like for a company like Meesho, is truly unique to India, and it's a unique Indian proposition. Zepto, Blinkit, Swiggy, Instamart, the business model and unit economics actually did not work anywhere else in the world versus in India, where sort of quick commerce, etc. took off, right? So in consumer and financial services, now we have a propensity to back Indian models for Indian consumers at a price point and unit economics that makes sense for India, which is not a replica of what has been built in US and China. So that's the first change that I've seen, where as the cycle of investing, then IPO, then getting DPI has happened, people have become more emboldened, and also the Indian consumer has shown that it's an appetite to support a company to get to IPO in sort of 8 to 10 years. So that's the first change. Second, and I think which will be the biggest change over the next 8 to 10 years, is just focus on deep tech. 5 years back, hardly anybody was investing in deep tech. Especially today, given how geopolitical environment is panning out, and every day on Twitter we hear about, like, every political action is now a geopolitical and supply chain action. In that dimension, I think deep tech will become incredibly important over the next 5 to 10 years. 5 years back, nobody was looking to back deep tech. But over the last 5 years, a combination of three, four things. A, I think incredible support and push by the government. B, really high quality entrepreneurs coming out. And three, the need for indigenization of the entire supply chain across compute, which is semiconductors, data centers, AI, energy, which is EV, energy companies like Loham, Ola Electric, robotics, space tech, defense, has necessitated that a lot of focus over the next 5-10 years will be on deep tech. So for me, two key changes. One, we are now backing India first models in consumer and financial services. And two, we are now comfortable investing in binary ideas in deep tech, which was not possible 5 to 10 years back.
Thank you, Sudipto. I think the sense that we get is as we cover the entire panel, there is a clear trend that is emerging, which is India focused, what is suited to this economy, and also likely to take us to the next leap, because deep tech and technology integration is something that everyone seemed to talk about. But how far is we had several themes running in venture investing in the past: climate tech, AI, deep tech, and so on. But is that not necessarily just a cycle that we see, or are there real reasons to believe that okay, here is a clear shift that is happening rather than just a cycle that could be playing? I don't know who in the panel could take this. Yeah.
I don't think it's a cycle. I think some of these trends are very, very structural. The energy transition is real. There's a lot of movement towards electrical vehicles and solar. You make money when you're ahead of the curve, right? I mean, in our industry, you have to invest before the others figure it out. So I think we always keep looking at, okay, what is going to happen 5, 10, 15 years on? Because you're going to sell into a market which is thinking of something as the hottest thing. But when you're investing, it should not be the hottest, otherwise you'll pay a price, you'll not make money, right? So Loham's example, in 2020, you're thinking, okay, maybe China will turn off the critical minerals, maybe they will not supply you stuff. I think we thought, yeah, that can happen. There is some probability of it happening. We put in, we got a good price. Today it is China actually turned off the critical minerals. All those things came true, and now it's driving the whole geopolitics. Same thing, we invested in this company called Aditya. They have a autocom business, but they were developing this magnetless motor at that point in time, which is based on Swiss reluctance technology. So we said, okay, maybe China turns off the magnet supply also, and everyone might look for China plus one. Today, that has happened also. So, and that now company has made us a lot of money. Their magnets are not going to the EV ecosystem; they're going to durable ecosystem. Havells has given them orders to build magnetless fans because they want to cut their dependence on China. So you have to stay ahead of the long-term mega trends on technology, whether it is AI, whether it is EV. AI again, this company in Tangle that has been there in 2016. US guys figured it out first. They already have Samsara, which is listed with 20 billion market cap. Indian auto companies, and that's a. I think we are all supporting deep tech, and I think the biggest challenge that I see is that our corporate ecosystem is not fast, agile, and they don't want to pay. They just don't want to pay. There are too many. No, I don't want to use that word. There's too many of them just trying to squeeze. They say हम आपको opportunity दे रहे हैं धंधा करने की, हमारे लिए तो free में करके जाओ. भाई वो startup है, कैसे free में करके जाएगा? उसको तो पैसा चाहिए ना. So I think that attitude also has to change. So some of our companies built top class world beating products, but when you take it to the largest corporates in India and they want them, they need them, they say it is better than anything else they have seen in the world. And then they say, no, you do हमारे लिए free करो, हम आपको chance दे रहे हैं काम करने का. मतलब that thing has to change. But I think market is ready. It is super critical. People who back it will make a ton of money because they do it ahead of the curve. And all of these technologies, whether it's biotech, AI, energy transition, they're all real. They're multi-decadal opportunities there.
Yeah, thank you, Arul. I think it makes a lot of sense to say that stay ahead of the curve, diagnose and detect the mega themes, and time it well. You are actually awash with money, and one can clearly see geopolitical shifts, which would present opportunities. But I think venture investing is still a very mystified, not so not so legible to the rest of the world. I just want to therefore go back to Anirudh and Sudipto to really see, is there anything that you do to decode what we call the structural shift from a fad? let's start with Anirudh. Yeah.
So to me, to be honest, I'm not as I don't think too much about uh, fad versus the only place where the fad. In fact, an ex-colleague of mine used to say this that whenever there is a sector of the year, in that sector of the year, any deal you do, in cricket terms, तुम्हारा hit wicket होगा, So that's what he used to say, and it's very true. So to me, fad is more about just momentum investing, where everybody else is going just because everybody else is going in that direction. But the real value of a business really is, are you able to create value for your client? Now, it may so happen that that business is in a sector where there is a lot of momentum, etc. But if that is the case, then so be it, right? But if there is a business which I'm trying to think of examples, if you go back to the 2015-16 era, you had a lot of hyper-local marketplaces which started out. You had Swiggy, which started then. You had Urban Company, which started then. Meesho started, I think, in 2017 or so, or 18, but around that time. You had a lot of hyper-local, Swiggy was for food, there was something for dhobi, there was something for maids, which we have again now, which is doing well. But you had a lot of these, something for car wash, everything. So that was a fad. And to me, I wouldn't have, I invested in Swiggy at the time at Series B, but I wouldn't have had a problem with some hyper local marketplace for maids or for car wash, as long as it is delivering value to the client. If the company is doing that, then it is if it has strong fundamentals, if it has strong unit economics, then the company has to have certain moats, has to be sustainable. And if that is the case, I don't really mind if it's in today's world AI, right? AI is the latest fad. Now we are privileged to partner with Bearing on a company which Arul talked about called Entangles, which has built the world's first foundational AI model for vehicles, for trucks. When it comes to the question of predictive maintenance, being able to tell a truck owner that in 3 weeks from now, your truck is not going to work because of so and so reasons, no one can do that. Entangles, which started out in 2016, did that. They didn't do it thinking कि हम एक AI model बना रहे हैं. They did it thinking that this is a tough problem to solve. We have the technology capability to solve it, so let's try and solve it. And now today it so happens that they are probably the most scaled up vertical AI company out of India. So even though it's part of a fad, it's not really being driven by that fad. The company is being driven by its own merits, because the technology which they've built is truly superior and better than any other company globally, be it US, Europe, anywhere else. So as long as the company is able to deliver real value to the client, they have real P&L, they have real unit economics, and they are profitable, can be profitable in the future, and not just rely on external capital. Even if a company or a model is part of a sector which is which has a lot of momentum, I think the company itself will do fine. And our job as investors is to identify those specific types of companies, even if they're part of a very momentum-driven sector.
Over to Sudipto. I think from the portfolio companies that you have from Razorpay to Allah, do you really have some themes visible there, or they are like opportunistic play, or you clearly see some of these mega trends being shared across them?
So I got a chance to speak with Lee Fixel of Tiger long time back, and he essentially said that in VC, you need to do two things right. You need to pick trends ahead of time, and you need to pick people ahead of time. To Arul's point, that's where all the alpha is, right? Where you're early to an opportunity and you're early to back an entrepreneur till essentially his or her entire potential is clear to the world. So as a VC fund, our job is to pick trend lines ahead of time. If we are not doing that, then I think we are not doing justice to at least very early stage investing. And we are early stage investors. We invest in technology companies at seed, Series A, Series B. And I think everywhere in the world, people are trying to figure out trends. Now to Anirudh's point, right? In the last 20 years, there have been a lot of fads. 2006, 2007, there was clean tech 1.0 fad. 2020, 21, we don't, like, I'm not sure if blockchain was completely flat, but crypto and NFTs and a bunch of $10 million art on NFT was definitely a fad. Whether AI is a fad or not, I don't think it's still a question, but there will be systemic changes and shifts in the technology landscape from time to time. The big question as early stage investors we need to answer is whether this particular shift is going to be there 5, 10, 15 years down the line or not. And there, I think the only way to answer anything is customer backwards, which when Anirudh was mentioning. In the end, customer is the king. Whatever you are building, who is the customer? Does it solve a real value problem for that customer? And if that is true, then that's not a fad. For example, if I look in 2025, the most amount of dollars in China went to robotics. The second most amount of money that went in US was in robotics. Now there's a key question. There are 15, 20, 30, 40 billion dollars of money going into robotics every year, but there are no customers for robotics. Is it a fad or not is a question we need to answer if you have to invest in robotics. Because if you're investing in a robotics company, you are essentially saying that over 3 rounds you will put 40, 50 million dollars into it. And the way we think about it is today there is no demand because there is no high quality supply of robots. The reason there are no high quality supply of robots is if you take a robot, we break the robot down, and then we say that locomotion as a problem statement is solved, but dexterous manipulation, which is what a robot does with a hand, is not clearly solved. Is there a path for that to be solved? And the answer is if you talk to enough folks in research across the top universities in robotics, you will realize that if you have enough amount of physical data to train a robot on how to do particular tasks with hands, over 2 to 3 years that can be solved. So that's on the technology part. So first we take a step back and say, can the tech be built? Then the second part is, if the tech is built, what's the utility to the world? Now the largest market in the world is actually services TAM. Today with AI, we are actually replacing the work that human beings want to do. Like we want to do art, we want to do science, we want to build movies, we want to do copyright. Nobody wants to clean. Nobody wants to lift boxes. Nobody wants to go inside a mine and endanger their life. Nobody wants to be on the front line of military if given a choice and sort of sacrifice their life, right? So if I just think about utility of AI, a fully functional robot actually solves the tasks which human beings don't want to do. Agentic AI is taking away all the nice things I want to do. I don't want AI to write a book. I don't want AI to write a film. Outside of voice AI, control center, etc., a lot of the other stuff is what human beings want to do. So, as a 10-year thesis, when I look at robotics, I think when the robot starts working, its adoption will happen. And world over, there's $40 trillion spent every year on services and labor. So today it seems like a fad because money is going into that space, but there's no revenue. But when dexterous manipulation is solved, which seems to me that skilled by some of the companies in the US will solve in the next 2 years, I think robotics will take off, which is why I'll invest in something today which has no revenue, but that's my thesis, right? So when we are taking bets, that's how at least as early stage VCs we think about it, that if it works, how large can it be? What are the constraints in technology for today, and that can that be solved in the next 2 3 years? Because if it can't be solved in the next 2 3 years, we are too early and we end up losing money. But that's how we think about it. When we did the same thing about blockchain, and especially crypto, we just could not see the value of what will that $10 million NFT actually mean to human beings 5 10 years down the line, and we invested in nothing in blockchain. So at least that's how we look at, is there a really large TAM, and can a really 10x product be built over the next 4 or 5 years? What does it need to take in technology to solve for us to reach there? And sort of that's how we build our thesis.
Thank you. I think we have some sense of clarity here, if not ultra clarity. There is a sense that you have to be ahead of time and detect the curve, and unit economics really hold the key. And is customer king is one way to really see, are you too much ahead of the curve, so that you would really land well short of the runway, or you would be hitting when there is consumer demand. So I guess we have some insights here. Let's go back to Aastha and ask, while we talked about themes, do you really see an advantage for continuing this momentum that we have built in the Indus Valley for further startup funding in India? What reasons can we really see to be optimistic about, we build on this momentum for future?
So I think we're very bullish, of course, but I think 4, 5 reasons where structurally this asset class should do well in the next 10 years. One, of course, everything flows backward in my mind at least. The capital markets is doing very well. For the first time ever, India is giving exits. So the one problem that LPs we've heard says that you can invest and see markups, but there are no exits. So there's no money that goes out of the country. But thankfully, over the last 18, 24 months, some of those problems have started being solved. So there is some conviction. So I think there is some conviction being built in looking at India is not just a temporarily experimental market from an LP investment allocation perspective, but something that could consistently make a certain rate of return for them, at least for a certain pool of capital. We will still not be as large as China is potentially in terms of actually giving out those returns, but we're moving in that direction. So that's a big positive. The second, I think, is over the last 30 years, there have been a lot of structural investments that both governments have been doing and industries themselves have been doing. So if I look at multiple subsectors within deep tech, right, and I take space tech as an instance, ISRO has done a lot of work in creating an entire vendor ecosystem alongside certain components, so that today if there is a space tech company that wants to create a new type of component, they don't have to go to vendors only in the US, only in Europe to actually get a lot of the components supplied to them for them to actually do the next level R&D on it. The fact of the matter is, because the last 20, 30 years have gone into making investments in certain hardcore, I think, sectors like oil and gas, like space, sectors that actually might make a lot of difference. Today, there is a vendor ecosystem, there is a network of both experts, industry veterans, and capital providers who understand the market enough to be able to say that, okay, XYZ startup leading innovation in a certain area has potential to succeed because the market around it can also honestly support that transition to that particular technology. So that's the second big thing in my mind. The third thing is the fact that India has delivered on the initial promise, which is to say that because India has such a high population and there is a certain level of GDP growth that India has delivered over the last 20 years, at least there is the sector of consumer businesses that, if you're able to crack right, are able to deliver returns. In fact, they started off as primarily consumer platform businesses maybe 10, 15 years ago, but over the last 5, 7 years, brands have also made enough money for both ecosystem partners as well as founders and employees for India today to say that consumer as a market can of course make money, irrespective of whether you're an AI player, you're a hardcore brand, or you're a platform building player, as long as you're able to get the right depth of value proposition to the customers in the right manner. So I think these three structural changes, or these three structural evolutions in my mind, sort of create a much stronger position for India to hold this industry overall over the next 10 years as well.
Let us see if there is any quick additions to that. Let's go in row. Yeah, Arul, please.
I think it's Donald Trump. He's making it harder for Indians to find jobs there. Good, well-educated talent studying in the best labs in the world is going to come back to India. I think we are salivating to recruit them in our portfolio and make use of that. So that's going to be a big catalyst, and the whole geopolitics is, I think, pushing us towards becoming more self-reliant. One more complaint I had, obviously, we have been called to help people understand stuff, but let me be a little more selfish. I think there is this whole support from the government that has been coming to the startups, but there is whole intent, everything is there. I think the flow of money is still a little slow. uh, when I see any of the defense oriented or semiconductor oriented or space oriented startups, I would just, whoever has the power here, or because the minister is going to come next, I don't want to speak in front of him. Whoever has the influence, release the money a little faster, give advances, take risk. यूएस में डार्पा पहले पैसे देता है फिर प्रोडक्ट लेता है, यहाँ पे प्रोडक्ट देने के बाद वो पता नहीं कब पैसे आते हैं, 6 6 महीने बाद। वो प्लीज आप फिक्स कर दो यार, वो बहुत बहुत और पैसा हम देंगे। that is the cultural thing that someone was referring to earlier, right? Culture has to change. This is the cultural part that has to change. Trust people, yeah. I mean, those guys, students who are PhDs and doing some work, they're making something. पहले पैसे दे दो, ऑर्डर दे दो, बना के दे दें, उसके बाद बाकी पैसा दे देना।
So I had a similar conversation with somebody in MIT. द चैलेंज इज जो पहले अगर पैसे दे तो विदाउट प्रोडक्ट इंडिया में स्टूडेंट्स के पास पैसे आएंगे नहीं, वो चैलेंज हो जाता है. सो लाइक द राइट पीपल ऑल्सो नीड टू थिंक थ्रू चेक्स एंड बैलेंसेज, बिकॉज when you give money without checks and balances, unfortunately a lot of that has happened in the past, and then none of the deserving people end up getting the money. So that's also something that people have to balance.
I mean, the panel has strong reasons to believe that clocks are ticking in favor of India, and many grounded reasons for that. With that, let's shift the gear into something else. We know that it looks like a lot more money is now chasing founders, and venture capitalists are more like capital service providers, where founder is becoming a customer. So therefore, let's ask, like, beyond just giving check, do you really see what is it that the value addition that you could provide, and what challenges do you really see in backing up the ventures, because the founder should not really perceive you to be too intrusive, where you really draw the trade-offs, and how do you really encourage the founder to really be very transparent and honest with what is working and what is not working? Let's hear the panel out on the style reverse. I'll start with Sudipto.
So the first thing is, generally founders know more than us. If we are backing a founder where we know more than the founder, we are not going to make money. If I knew how to build a $10 billion company, I should not be a VC, I should be a founder. So first things, when we end up investing in founders, we are very founders first, which means we try to back founders in a particular sector where we believe that this founder is the best person in the country to solve this problem statement, which means whatever they have done in the past, their experience, pedigree, or how spiky they are, or their pulse on consumer generally is significantly better than everyone else. So that's the starting point, which means everything that we do for the founder is more pull versus push, which means we will help the founder with whatever he or she wants versus saying this is our strategy and this is how you should do it. Especially in early stage, that's the model most VC funds end up using. Now, within that, there are 2-3 things that we have seen consistently work well for founders. Is one, we help hire the L-1 team for them. I can see Amit here, who is also a portfolio founder. But net, I think as a founder, you have to solve 100 different things. Hiring your first 10 people is probably one of the big decisions that you take, and that's where we help, where we sit with the founder, figure out what are the roles you want to fill, interview hundreds of people, and then give the founder for every role 2-3 different people which we think are the best fit at that stage, whom they can interview and essentially hire. So that's one thing that we help. Second, in a lot of stuff around deep tech or B2B or enterprise businesses, given we're across multiple portfolio companies, we sometimes help give you access to first set of customers or demand. We can't do that in consumer, but anything that B2B or enterprise facing, especially now with deep tech and government facing roles, hopefully we can do some intros, which comes from a advantage of having spent time in that space for a long period of time. Third, we can never tell a founder what to do, but sometimes we can tell what not to do. And that's where I think the strategic value that we add, where we have seen enough number of companies and we have seen enough things that have not worked. And sometimes we can sort of nudge the founder and say, these are, I know you are going down this path, but 3 other companies have gone down that path in the past and it has not worked out. What will work out is true serendipity and only the founder can say. But we can help them hire a team, we can open doors, we can stop them from making mistakes. But all the right decisions actually have to come from the founder, and we are generally never prescriptive about it.
Thank you, Sudipto. You strongly believe in the pull model rather than the push model, but I think private equity can't really sort of run away from the fact that you are focused on operational alpha. So how do you really see you crossovering into startup and investing? Do you really continue to maintain the same genetic imprint of being able to really be hands-on or involved much to a greater degree?
Yeah, definitely there is a variation between how we deal with the large companies versus how we deal with the small companies. Large companies, we are paying full value and we are relying on growth, and there is work on productivity and of balance sheet, of people, of capital. Uh, but in the startups, I think our mantra is trust but verify. So if you put too much systems in a startup right up front and every day just trying to implement that, the guy won't grow. वो पतंग उड़ाते हैं ना, वो अभी काइट फेस्टिवल चल रहा है, ढील देनी पड़ती है, नहीं तो उड़ेगा नहीं. So you have to give them that breathing space, because this is first job or his first most important thing he has to do is find customers. If you find customers, you are much less likely to fail. Your odds of success go far higher. Beyond that, in the early growth ecosystem, I think ours is more of a need-based help. So we wait for the founder, or we look where does he need the help. If it is in recruitment, we give help in recruitment. If it is in capital raising, we give in capital raising. Most times it is in closing sales. Most companies die because they don't have customers. The rest of the things can be solved. Oh, there is ways to solve that. I think that's where our whole IMA thing helps, because a lot of the network, especially the senior members, have CEOs in different companies. So we try to refer the startups to go unse milke aao, and when someone goes with a warm introduction, you typically at least get a hearing, especially in B2B kind of roles. So that ends up being more of the value add that we do in the early growth part of the ecosystem.
Anirudh, is there a slightly different way in which you handle your portfolio companies?
Yeah, I mean, maybe I can sound a little bit contrarian right now to Sudipto because he comes from early stage. We do more growth stage. So taking an investment for a founder to take an investment from an investor is like a marriage which doesn't have the option for divorce. So one has to always keep this in mind, that this is a relationship you cannot terminate artificially. So for me, the benchmark of a good founder is somebody who is self-aware that they don't know everything, they will not know everything, and they should know what they don't know, or they should have the capability to identify the unknowns for them over time. That leads to their evolution. What works for a founder at an early stage will not work at a growth stage, and that will not work when you're trying to take your company IPO. Having that self-awareness is very important. So for me, while we, my training as an investor has been, such that I tell each founder that I come with a service mentality, that I am here to serve you. You are my client. And if you need my help, I am there. If you don't need my help, I'm not there. But I also want the founder to have a similar contract with me, where the founder doesn't claim to know everything and doesn't say that, okay, let's say I'm a tech first founder, I'm great at building the technology, etc. I don't have any knowledge in finance. Then I should not say that, no, I will run finance because I'm the founder. No, you need to be able to delegate, you need to be able to hire the right talent, you need to be able to get the right people in. It's the same as a relationship, right? My girlfriend, she has the patience of a saint, but when it comes to navigating directions, she is not good at all, right? But there is a self-awareness there. And so there are some parts she's good at, some parts I'm good at. And similarly, in a founder-investor relationship, it's the same thing, that there are some things which you will be good at, and there are some things which you will not be good at. So today, if a founder comes to me and tells me, can you help me with GTM or sales, how to build my sales engine, I'm the last guy to know anything about it. And my response has been in the past, when someone did ask me this question, is, I don't know anything about this, but I'll connect you to this person who could potentially help you. But when it comes to, say, questions of fundraising or M&A or general business strategy, I have a little bit more experience, right? That I can, in those areas, I would like the founder, say, who's raising money for the second time in his life or third time in his life. I have been doing this for 15 years, right? So I've seen all those tricks which investors play, all the games people play, etc., etc. I'm not saying I'm always right, but I can tell you a little bit more than what you already know. So that humility has to be there in the founder as well, that, okay, I will listen to this person, and doesn't have to be me, could be somebody else he or she listens to. But that humility has to be there, that I don't know everything, and let me turn to the right person, or let me hire the right people. And that's what the founder evolution which I was talking about, it's critical, because in a lot of cases I find that founder evolution to be missing. Even at a growth stage, founders will want a value. I'm sure we've all seen these examples. Founder will come and tell me, I want to raise money at 10 times revenue. Why? Because I raised money in 2021 at 10 times revenue. Yeah, but at that time it was a bubble market. The guy who invested in you is not going to invest in you again. So there is no logic to just saying I want a 10 times revenue multiple. So that rationalization, that sense of logic, all of those things need to be there in the founder as well. And for me, it's very clear. I have, or me and my fund, we have certain things we can do, help the founders in. For instance, finance, M&A, etc. We can help them with GTM. We can help them in a few more pointed areas. Outside of that, if you want help, we'll connect you to the experts. But it's equally important for the founder to recognize what they don't know. So, yeah.
Thank you, Anirudh. I think he's saying, okay, focus on where you can contribute, and let's invest with founders who can recognize that what they know, what they don't know, and that will make the difference. But that puts us into the challenge that when things are really going bad news to be broken with the investor. How do you really encourage founders to really come and give you the bad news so that you don't really get caught by surprise? Any quick thoughts, Aastha?
Yeah, actually, in my mind, that sort of ties into your previous question as well. So, at least the fundamental philosophy so far has been to almost act like a guardian, an external guardian that's thinking about the portfolio business consistently. So, whether there are regulatory changes that we see that could potentially be a risk, whether there are changes on maybe the meta algo that could potentially just take CACs off out of whack for the next couple of months, or it could be newer subsegments opening up that could sort of infringe upon the current major profit pool of the company. The idea is to always also keep an eye out for all of them, to sort of actively give a preventive warning to founders for them to have some more time to think about these problems. Now, whether or not they actually come into picture is something that is outside of everybody's control. But what you can essentially do is give them that leeway of time, of bandwidth, and of actual awareness to also sort of adapt to those situations a lot faster. And that agility helps in sort of making use of all of these advantages that uncertainty sort of brings. So the fact of the matter, at least the way we've seen it work here, is that because you're consciously looking out for them and actively warning them for anything that may go wrong, it's easier for them to sort of reach out to you if there is a red flag in the business they see upcoming, because they see you as trusted partners, not somebody who will actually take their words and sort of put it back to them at some other point in future. So that relationship becomes a lot better. That's been my learning, at least.
I mean, yeah, it looks like the secret sauce is built a relationship as good as that being of a partner. That's what the investor and investee relationship is. I think we are running quite in tight in terms of time for this panel, unfortunately. So my guess is that we have to end here.